Hello everyone, welcome to this edition of CRISIL TV. Today I am going to share with you some of our perspectives on the banking sector. So, the headline news in the banking sector today is the impact on asset quality at public sector banks. At CRISIL, our estimation is that weak assets in the banking system will go up to 8.9% as of March 2017. A key reason for this is the fact that the credit outlook that we have on investment-led sectors like power, capital goods, metals and so on is weak, and a quarter of the loan book of the banks that we have in India are to these sectors. So if there is stress on those sectors, it will translate into weakening in the asset quality of banks. The weakening of the asset quality, among others, will result in an impact on profitability of public sector banks. We believe that provisioning costs for public sector banks over this current financial year and the next financial year would almost equal to their pre-provisioning profits. Now, in addition to that, there will be an impact on the net interest margin of public sector bank to the extent of 10 basis points because of the introduction of a new form of lending rate paradigm called the marginal cost of fund lending rate, which comes into effect from April 2016. In addition, the Uday scheme replacing state government loans with bonds will also result in a small decline in the yields that public sector banks generate on their assets. We also will see the weak assets generating lesser interest or yield on the books, because once an asset turns NPA, they do not generate yield for the banks. So, a combination of all these factors would lead to a 10 basis point reduction in the net interest margin of banks, public sector banks. Private sector banks, on the other hand, would not be impacted so much because they have high revenue diversity with a large exposure towards the retail sector as well as a significant portion of fee-based income in their overall total income base. They also have lesser exposure to the vulnerable sectors which are investment-led and which I talked about earlier. Coming to the capital sufficiency of banks, we believe that public sector banks would need an additional Tier 1 capital of 1.7 lakh crores till March 2019. Now, this is over and above or this is higher than the 1.3 lakh crores which we had predicted earlier, because the recent dent in the profitability of banks has meant that their ability to generate internal accruals has diminished. Now, what does all this mean for the adequacy of the banking sector to meet credit demand from the industry going forward? Now, we believe that banks will be adequately placed to meet the credit demand expected of them for fiscal 2017 for the very simple reason that we do not expect a significant investment uptick in the next financial year. We believe that private sector investment would be muted and probably pick up slowly towards the end of the financial year. But as a whole, the credit requirement from the banking system would not be very high. So, we believe that private sector banks would lead the credit growth with a growth of more than 20%, and public sector banks would follow at around 8 to 9%, resulting in an overall banking sector credit growth of around 11%. So, on an overall basis, banks should be in a position to meet the credit requirements expected of them for the next financial year. In addition, if there is a requirement, there are always NBFCs and the capital market to meet these funding requirements. So, that in a nutshell were the key messages that we have at this point of time about the banking sector. We thank you for your attention here and hope you will be tuning into this space going forward as well for further updates. Thank you.